Okay, welcome to this explainer. Today, we're diving straight into the high-stakes global race that's redefining the very foundation of how we pay for things. We're standing at a critical juncture in financial history, right at the moment where the physical cash in your wallet is rapidly being reimagined into digital code. But the million-dollar question is, who exactly will write that code, and who's going to control it?
Here is our agenda. We'll be looking at 1. The digital money revolution. 2. Public versus private money. 3. Why governments want CBDCs. 4. Privacy and surveillance concerns. 5. The global regulatory race. And 6. The future of finance. We're going to navigate this incredibly complex landscape by breaking down everything from the core definitions of digital money to the very real privacy concerns, and finally, the geopolitical chess match shaping our global financial system.
Part 1. The digital money revolution. As physical cash usage drops, a massive transition is already underway to build the next generation of financial infrastructure.
Just look at this number, 134. That's how many countries are actively exploring digital currencies right now. To put that into perspective, that represents a staggering 98% of the entire global economy. This isn't just a fringe tech movement anymore. It is a fundamental rethinking of sovereign currency by almost every major central bank on the planet. Part 2. Public versus private money. Let's see how this shift sets up a fascinating tug-of-war between state-backed money and privately issued alternatives.
So, the crucial point here is the fundamental difference in who is actually backing the money. On one side, we have central bank digital currencies, or CBDCs. These are legal tender, meaning you literally can't refuse them for debts, and they are a direct liability of the state. On the flip side, we have stablecoins and crypto. These are private liabilities. Even when a stablecoin is pegged exactly to the US dollar, it's still issued by a private company and backed by private assets or algorithms, absolutely not the full faith and credit of a government.
And wow, does that distinction matter? Private digital currencies can be intensely volatile. The Terra USD crash serves as a stark reminder that algorithmic stablecoins, which are basically digital tokens managed by complex code rather than physical cash reserves, carry huge inherent risks. When a private peg breaks, real people lose their money. This volatility is exactly why so many consumers and massive financial institutions might strongly prefer the bedrock safety of central bank money. If a crisis hits, a central bank can always print more money. A private protocol just can't.
Part 3. Why governments want CBDCs. What is actually driving central banks around the world to develop their own digital money in the first place?
Well, research shows governments are motivated by a really interesting mix of internal needs and external pressures. Internally, they want to boost financial inclusion, getting bank-like services to the unbanked, while also lowering the friction and costs of our current payment systems. But externally, there is immense pressure. If commercial activity suddenly shifts over to private cryptocurrencies, central banks are terrified they could lose their grip on monetary policy, the exact mechanisms they use to control inflation and keep the economy stable.
Plus, for massive economics, there's a huge geopolitical motivation. For nations like the US, the dollar's dominance is a foundational pillar of national security. Designing a digital money infrastructure isn't just about domestic payments. It's about maintaining standard-setting power and ensuring that democratic values remain completely embedded in the global financial system of the future.
Part 4. Privacy and surveillance concerns. Now, this brings us to a massive, totally valid consumer fear surrounding data privacy and potential government overreach. If the government issues digital money, can they track every single cup of coffee you buy? It's a major fear. However, academic analysis, like this one from the UF Law Scholarship Repository, points out a really practical reality. Creating a CBDC system purely for surveillance just isn't economically or operationally efficient. In authoritarian regimes, governments already have access to banking data. They really don't need a CBDC to spy on you. And in democratic nations, central banks simply lack the incentive and the legal mandate to act as retail mass surveillance hubs.
But there is another major practical concern beyond privacy: disintermediation. Imagine a system where the central bank issues digital money directly to you, completely bypassing your local bank. If everyone moves their money out of traditional accounts and straight into a central bank wallet, it would siphon vital deposits right out of the commercial banking sector. Since commercial banks rely on those deposits to fund local loans and mortgages, a poorly designed CBDC could inadvertently wreck the local economy.
Part 5. The global regulatory race.
So, with all these theoretical pros and cons on the table, efficiency versus privacy, public versus private, how are countries actually regulating this space?
When we look globally, regulators generally choose one of three paths. An accommodating approach tries to safely fold crypto into the regulated banking system. A laissez-faire or hands-off approach is actually super rare because it directly erodes a state's monetary sovereignty. Finally, an outright ban is used by a handful of states, most notably China, to restrict private on-chain activities, ultimately clearing the runway for their own state solutions.
This is creating a fascinating geopolitical divergence. We are seeing major economic blocs chart completely different courses right now. While Europe and China are aggressively pushing forward with state-issued public CBDCs, the United States is leaning in a very different direction, opting to regulate private sector stablecoins instead. To understand just how sharp that U.S. pivot has been, check out this recent timeline. Back in 2021, the Federal Reserve was actively researching a U.S. CBDC, but by January 2025, Executive Order 1478 essentially bans a U.S. CBDC entirely. Instead, the focus shifted strictly to the private sector, resulting in the Genius Act later in 2025, which laid down a framework for private stablecoins. By stepping back from a public CBDC, the U.S. is practically giving China and Europe's digital currencies free rein in the state-backed arena, while placing all its bets on regulated, privately issued money.
Part 6. The future of finance. Where does this incredibly complex regulatory chess match leave the ultimate future of our money?
According to industry experts like Dante Disparte at Circle, it might not have to be a zero-sum game. As clear legal standards finally emerge, it's paving the way for what he calls co-opetition. This means traditional banks and nimble private fintechs are beginning to work together, building a shared, risk-managed infrastructure where regulated digital money can actually scale safely across the internet.
Ultimately, as Laura Talvati points out, the global race isn't really about replacing legacy currencies like the dollar. Instead, it is a fierce competition over who builds, governs, and completely controls the underlying digital networks those currencies are going to run on. The infrastructure itself is becoming the new reserve system. Which leaves us with one final critical question for you to ponder as we wrap up this explainer. The technology is already here, the transition is inevitable, and the global regulatory frameworks are being locked in right now. When it comes to the future of your wallet, who do you trust more to govern its infrastructure, the state or the private sector?